Welcome to Wealth Hustle 247 podcast, your trusted guide to financial literacy, business innovation, and entrepreneurial success. Learn how to grow your wealth, make informed decisions, and turn your ideas into profitable ventures.
Want to master the art of investing? In this episode, we reveal the most important lessons in investing, essential wisdom to grow your wealth. Let's get started.
All right, get ready to level up that financial game, because today we are diving deep into the world of investing.
Ooh, sounds exciting.
It is. We're going to be extracting some serious wisdom from, get this, the most important lessons in investing.
Kitschy title.
Right. And trust me, this source, it's packed. It's jam-packed with insights to help, well, anyone really, build a brighter financial future.
I mean, who doesn't want that, right? A brighter financial future.
Yeah.
I know I do. And this book, it really is like a gold mine of information, whether you're just starting out, dipping your toes in the investing waters, or you've been doing this for a while and you're just looking to refine your strategy a little bit.
Yeah, absolutely. Okay, so enough teasing. Let's just jump right in.
Let's do it.
So I've always been kind of fascinated. I don't know about you. I've always been fascinated by this whole concept of compounding.
Oh, yeah. Compounding.
Yeah, I mean, Einstein, big brain Einstein, he supposedly called it the eighth wonder of the world.
Yeah, he did. He did.
So does it live up to all that hype?
Oh, absolutely. 100%.
Yeah.
Yeah. What's so amazing about it, is that it's like your money is like working for you. It's not just the money you put in at the start, but it's all the returns you earn. And then you earn returns on those returns.
So it just keeps growing and growing.
Exactly. It's like the snowball effect. But over time, it really starts to build up.
Okay, so I'm picturing like this tiny snowball rolling down a hill, right? And as it rolls, it gets bigger and bigger and bigger.
Yeah.
But how does that play out in the real world? Give me a for instance.
Okay, so the source actually, it gives this incredible example of this young woman, I think her name was Sarah, who starts investing just $50, $50 every week.
Okay, that's doable.
Right. Starting in her early 20s.
Early 20s, okay.
And by the time she reaches retirement, her portfolio, it had grown to, wait for it, over $1 million.
Whoa, $1 million from $50 a week. That's incredible. But I'm guessing she didn't just stash that cash under her mattress, did she?
You got it. So a really, really key principle here is reinvesting your earnings. So every time Sarah's investments generated dividends or interest, boom, right back into the portfolio.
Oh,
fueling even more growth.
So it's like planting a seed and then using the fruit that it bears to plant even more seeds.
Yeah, that's a great way to put it.
I'm sold. I'm sold on the magic of compounding.
Okay, but what about risk? Isn't it kind of dangerous to, like they say, put all your eggs in one basket?
You are absolutely right to bring that up. And that's where diversification comes in. This is huge.
Okay, diversification.
So the idea here is you want to spread your investments. You don't want everything in one spot.
Right.
Spread it across different asset classes like, stocks, bonds, real estate. You could even look at things like gold or commodities.
Okay, so if one investment goes, totally sour, the other can hopefully cushion the blow a little bit. Exactly. Think of it, I always go back to food.
Okay.
Think of it like a well-balanced meal. You're not just going to eat one type of food, are you? Hopefully not.
No, I like variety.
You want variety,
Yeah.
right. Lots of nutrients to stay healthy. Same principle applies to investments.
Okay, that's a good analogy. I can get on board with that.
Huh.
But I got to be honest, all this talk about asset classes and stuff, my head's spinning a little bit. How do you even know where to start?
Right. Well, luckily, there are some tools, some really helpful tools out there. Have you ever heard of mutual funds?
Yeah, I've heard of them, but to be honest, I don't really know what they are.
Okay, well, mutual funds, and then there are these things called ETFs or exchange-traded funds. They're kind of similar.
Right.
What's so cool about them is they allow you to invest in a bunch of different assets, like a whole basket of them, but you just buy one thing, so you instantly get that diversification we're talking about.
Oh, okay, so I could buy one ETF that holds stocks and bonds and even real estate. That sounds way more convenient.
It is, right. It's a great way to kind of dip your toes in, especially if you're not ready to pick individual stocks or bonds.
That's a relief.
Yeah.
But let's be real, investing, it can be a little bit scary, right? I mean, there's always the risk that you could lose money.
Yeah.
How do you balance that fear with, the potential for growth?
That's a really good question. And this is a crucial point. So it's all about understanding your own risk tolerance. Some people are totally cool with like a lot of volatility, a lot of ups and downs.
Yeah.
But some people, they prefer things to be a little slower, a little steadier.
I think I'm more of a slow and steady wins the race kind of person.
Yeah, me too. And the source actually mentions this tool called the Sharpe ratio. And it can, it sounds complicated,
Yeah.
but it can really help you assess, is the potential return worth the risk I'm taking on?
Okay, Sharpe ratio. I'm sensing things are about to get a little technical. Can you, break that down for me a little bit?
Sure. So imagine you've got like two investments, right? One of them is like super jumpy. It goes up and down, like a roller coaster.
Okay, I don't like roller coasters.
Right. And then you have another one that's like slowly climbing, but it's very steady. The Sharpe ratio helps you see which one's actually giving you a better return for the amount of risk you're taking on.
Okay, so it's not just about how much an investment could grow, but it's also about how much risk you're taking to get that growth.
You got it. And once you kind of know your risk tolerance, you can start thinking about asset allocation.
Asset allocation.
Which is basically, deciding how much of your investment pie goes to each asset class.
So we're talking like pie charts and percentages here.
Exactly.
Okay, so I like pie.
And there's this kind of rule of thumb, to get you started. It's called the 100 minus your age rule. So you subtract your age from 100, and that's the percentage you put into stocks. And then the rest, you put that into bonds, which are usually a little less risky.
Okay, so the older you are, the less risk you take.
Yeah, that's kind of the general idea.
Okay, got it.
Yeah.
But what if I'm just not comfortable with, that much risk, even if that's what the rule says?
You are absolutely right. It's not one size fits all. So your individual goals and comfort level, they absolutely come in. The key is you got to find a balance that lets you sleep at night.
Oh, yeah. I'd rather have peace of mind than a portfolio that's giving me nightmares.
100%. Speaking of sleep, have you ever laid in bed, tossing and turning, worrying about what the market's doing?
Oh, all the time. Especially when I see, headlines about the market dropping, I start to panic a little bit.
Yeah.
Should I sell everything?
You are not alone. Emotions are the investor's biggest enemy.
Oh, really?
Yeah. Because fear makes you sell low.
Okay.
And then greed can make you buy high, which is the opposite of what you want to do.
Yeah. So how do we keep those emotions in check? Is it even possible?
It takes practice. But there are definitely some strategies, some really good strategies that can help. And the source highlights this thing called dollar cost averaging. Super powerful tool.
Dollar cost averaging. Remind me what that is again.
Okay, so basically it's investing a set amount of money, whatever you're comfortable with, at regular intervals. Doesn't matter what the market's doing, up, down, sideways, you're consistently buying in.
So it's kind of like a disciplined savings plan, but for investments.
Exactly. And it takes the emotion out of it. So you're not making these rash decisions based on fear or greed. You're sticking to your plan.
Oh, okay. That makes sense. I like that. It feels more controlled,
Right.
more strategic. But the market, it's constantly changing. How do you stay informed and make sure that your strategy is still, working?
That's where continuous learning comes in.
Continuous learning.
The financial world is constantly changing, so you got to stay curious. You got to stay informed.
Okay, I have a confession. I recently went down a total rabbit hole reading about real estate investing. And I don't know, I kind of geek out.
That's awesome. That's great. It shows you're already embracing that learning mindset.
Yeah.
And there's so many resources available, websites like Bloomberg, Investopedia. There are tons of podcasts out there.
Hey, shout out to the deep dive.
Yeah,
But seriously, the more we learn, the better equipped we are to navigate all this, right?
absolutely. Speaking of navigating, have you ever wondered if there's a way to ride the market wave instead of trying to outsmart it?
Now that you mention it, I've heard this thing called passive investing.
Yes, you're on the right track.
Okay.
Passive investing, it's all about tracking a specific market index. So instead of picking individual stocks, you're just going with the flow of the market.
So less about actively managing and more about letting the market do its thing.
Yeah, and it has a really impressive track record. Over the long term, it often outperforms those active trading strategies.
Really? How come?
Well, for one thing, you're taking the human emotion out of it.
Right.
And usually it's more cost effective because you're not constantly buying and selling, racking up all those fees.
Okay, so what are the best ways to do this passive investing?
So index funds, those are great. And ETFs, remember we talked about those? They're designed to track a specific index, and they're known for their low fees.
Okay, this is making me rethink my whole approach.
Yeah.
But even with low-cost options, aren't there still fees and taxes that can eat into my returns?
You're absolutely right. Think of fees and taxes. I always think of them as like termites.
Termites.
Yeah, they're just silently nibbling away at your investment house, you know? Even small fees, they can compound over time and really impact your growth.
Yikes. Okay. I don't like termites. So
Yeah.
what's the best defense against those financial termites?
Well, prioritizing those low-cost options like index funds and ETFs, that's a great start. Also, 401k, IRAs, remember we talked about those?
Investment accounts, right?
Yep, they can make a big difference.
Okay, I know they're good for taxes and stuff, but I don't really get how they work.
We'll dive deeper into those in part 2, but basically, you get some tax benefits either now or in the future, depending on the type of account.
Okay, consider that a teaser for part 2. But before we move on, there's one more termite I want to ask about: tax loss harvesting.
Oh, yeah, good one. That's where you strategically sell investments that have lost value to offset gains.
Sounds complicated. Should I call my accountant?
It's something to explore later on. Consider it like a pro-level move.
Okay, I'll add that to my list. Now, I have a confession. I've totally fallen victim to following the crowd when it comes to investing. I remember this one time I got this hot stock tip. It was a disaster.
Yeah, that herd mentality, it can be tough to resist. It's that urge to follow the crowd, even when it's not the best idea. It can really lead to some bad decisions, buying high, selling low.
So how do we resist that? Especially when it seems like everyone's making money except for you.
You gotta have a solid strategy.
A strategy.
Based on your goals, your risk tolerance, your own research. Don't be afraid to be a contrarian.
Contrarian.
Yeah, going against the grain.
I like that. Sounds kind of rebellious.
It is. Think for yourself. Make informed decisions.
Okay, I'm feeling empowered already. But if there's one thing I struggle with, it's patience.
Ah, patience. The investor's most valuable virtue, but also the most elusive. It's so tempting to try to get rich quick, but investing, it's a marathon, not a sprint.
Okay, if Warren Buffett says so.
Exactly. So shift that mindset. It's about building wealth steadily over time. Resist the urge to tinker, to react to every little thing the market does.
That's a good reminder. Speaking of market fluctuations, what about the ups and downs? How do we handle that?
Think of it like the ocean. There are tides. The market's the same way. It goes through cycles.
Oh, okay.
And downturns, they can be scary, but they also present great opportunities to buy.
That's hard to do when everyone else is panicking.
It is. But remember dollar cost averaging. That's your friend in these situations.
Okay, so we're being patient, we're riding the waves, and we're avoiding the herd. Anything else we should keep in mind?
Yes, a big one, invest in what you know.
Oh, that reminds me of this one time I got pulled into this investment that sounded amazing, but I didn't really understand it. Big mistake.
Yeah.
Costly mistake.
It happens.
Yeah.
It's so important to thoroughly research anything before you jump in. Warren Buffett, he's famous for this. Stick to what you understand.
So I can't explain it to somebody else. I probably shouldn't be investing in it.
Exactly. Ask questions. Stick to your comfort zone.
Got it. Okay, so we're being patient, staying informed, investing in what we know. What's the driving force behind all of this? What are we working toward?
Financial goals.
Financial goals.
They're your investing compass, early retirement, a dream house, your kids' education, whatever it is. Those goals should guide every decision you make.
It's like having a destination when you go on a trip.
Exactly. And you know, there are tools out there that can help you stay on track. Financial planners, budgeting apps, all that good stuff.
Okay, we're setting goals, making a plan. Anything else we need before we jump into investing?
Yes, one more thing, and it's crucial emergency fund.
Ugh, I knew you were going to say that.
I know. Saving is hard, but think about it. What if your car breaks down? Unexpected medical bill. You don't want to have to sell investments at a loss to cover those things, right?
Definitely not. So the emergency fund's like a safety net.
Exactly. It keeps you from making rash decisions.
How much should we aim for?
3 to 6 months of expenses. Keep it in a high-yield savings account.
Great tip. Wow, we've covered a lot. Compounding, diversification, risk, emotions. It's a lot.
It is. But we're just getting started. And remember, no investor is perfect. Everyone makes mistakes.
That makes me feel a little better.
The key is to view those mistakes as learning opportunities.
I love that perspective. It takes the pressure off.
Investing is a journey. Mistakes are part of it.
Welcome back, everyone. I don't know about you, but I'm still kind of processing all that investing wisdom we unpacked in part 1.
Lots to digest, for sure.
Right. Are you ready to dive into even more strategic insights from, the most important lessons in investing?
Absolutely. Let's keep this momentum going.
Okay, perfect.
Yeah.
But before we, venture into uncharted territory, let's just do a super quick recap, like a refresh of what we talked about in part 1.
Yeah, good idea.
So we covered like the magic of compounding, the whole make your money work for you thing, the importance of diversification. Don't put all your eggs in one basket, right?
Right. Spread that risk.
Exactly. And then, how to manage risk. Can't forget about that. And, we touched on the whole emotional roller coaster that investing can be, the benefits of passive investing. And, those pesky fees and taxes. Oh, and of course, the emergency fund. Can't forget about that.
The foundation of it all.
Right. It's like building a house. You need a strong foundation before you can even start thinking about the walls and the roof. Right?
100%. Got to get that base solid.
Okay, so foundation set. What's like the next step in building our investing house?
So let's talk about the different rooms in this house, so to speak.
Rooms. Okay, I'm intrigued.
Yeah, so basically the different types of investment accounts. Like, where are you actually going to keep your investments?
Oh, okay, yeah, the accounts.
Right.
Yeah, I know there are a bunch of them, but I'll be honest. Sometimes it's hard to know which ones are right for me. Like, which room should I be in?
It can be a little overwhelming. We briefly talked about, 401ks and IRAs, which are both great for retirement savings.
Right. I actually have a 401k through work, but I'll be honest, I'm not really sure how it works. Like, what's actually happening in there?
Okay, so basically, it's a retirement savings plan, and it's sponsored by your employer, which is pretty cool.
Okay.
You contribute a portion of your paycheck, and a lot of times your employer will actually match a percentage of your contributions. So it's basically free money.
Okay, free money, I'm listening. So I get that part. But what happens to the money once it's in there? Is it just sitting there?
Nope, definitely not sitting there. It's invested, usually in a mix of assets, and you can usually choose those assets from a list that your plan provider gives you.
Okay, so I have some say in it.
You do. And here's the key. The money grows tax deferred, so you don't pay taxes on it until you take it out in retirement.
Oh, okay. So it's like a tax shelter for my retirement savings.
Exactly. And that can make a huge difference. Really add up over time.
Okay, that's making more sense. What about IRAs? Are those similar?
Yeah, they're also for retirement savings, and they have similar tax advantages, but they're not tied to an employer.
So I could open one, even if I'm self-employed or don't have a 401k, through work.
Yep. And there are two main types of IRAs, traditional and Roth.
Okay, traditional and Roth. I've heard those terms, but I don't know what's the difference.
So with a traditional IRA, your contributions, they're usually tax deductible the year you make them,
Right.
but you pay taxes on the money when you withdraw it in retirement. A Roth IRA, it's the opposite. You don't get a tax deduction up front, but your withdrawals in retirement, they're tax-free.
Tax-free, that's pretty appealing. So which one's better?
It really depends on your situation, your income level, when you think you'll need the money. It's a good idea to talk to a financial advisor about that.
Okay, so not a one-size-fits-all situation. Got it. Now let's step out of the retirement wing of our investing house.
Where are we headed now?
Let's explore, I don't know, maybe the living room, the taxable brokerage account.
Okay, I like it. So taxable, meaning you pay taxes on the earnings, right?
Exactly. No tax shelters here.
Right. These accounts don't have the same tax advantages as retirement accounts, but they offer a lot more flexibility.
Okay, flexibility.
You can withdraw the money at any time, no penalties, and you have a lot more investment options.
So it's like a trade-off. Tax advantages versus flexibility.
Exactly. And which one's better for you? It all depends on your goals and your time horizon. Like, if you're investing for a short-term goal, like a down payment on a house, a taxable brokerage account might be a better choice.
Okay, that makes sense.
Yeah.
So we've got retirement accounts, taxable brokerage accounts. Any other types of accounts I should know about?
There are a few more specialized ones, like 529 plans for education savings, HSAs for medical expenses. But the main takeaway here is different accounts. They serve different purposes, and the taxes work differently.
Got it. Find the right tool for the job. But once I've got my accounts set up, how do I actually choose what to put in them? Do I need to be like a financial genius to be successful at this?
Not at all. Remember, passive investing, index funds, ETFs, those are great ways to get started.
Right. But sometimes, I don't know, I get that fear of missing out. Like I'm missing some big wins by not picking my own stocks.
Oh, I totally get that. And for those who want a more hands-on approach, there's this concept called fundamental analysis.
Fundamental analysis. Okay, that sounds a little intense. What is that?
Basically, you're evaluating a company's financial health, looking at their future prospects, trying to figure out their intrinsic value.
So it's like looking beyond just the stock price.
Exactly. You're digging deeper, looking at the company's fundamentals.
So I'm like a financial detective, trying to find clues.
I like it. You're trying to uncover, is this company really worth investing in? And you're looking at things like revenue growth, their profitability, their debt levels, the management team, all those kinds of things.
Okay, those all sound important. But why is this so important for investors? What's the goal?
The goal is to find those undervalued companies, those companies whose stock price is lower than what they're actually worth. You want to find those hidden gems that have the potential to really take off.
So it's like finding a diamond in the rough, a company that's like poised for growth, but the market hasn't quite figured it out yet.
Exactly. And by understanding these fundamentals, you can make smarter decisions, reduce your risk, potentially increase your returns.
This is starting to sound like a lot of work. Do I need to go back to school for this?
You don't have to become a financial whiz, but it definitely helps to have at least a basic understanding of fundamental analysis.
Okay, basic understanding. Got it.
And there are tons of resources to help you. Websites, research platforms, even financial advisors can guide you through it.
Okay, good to know. Now, I've also heard of this other type of analysis, something called technical analysis. How's that different?
Great question. So fundamental analysis, remember, it's all about the company's financials. Technical analysis, it's all about market trends and price patterns.
Oh, so it's like looking at the charts and graphs.
Exactly. You're looking for patterns, trying to predict where the stock price might go based on its past behavior.
Almost like predicting the weather. Looking for those signs to see if a storm's coming.
Yeah, that's a great analogy. And, just like weather forecasting, technical analysis, it's not perfect.
It's an art, not a science.
Exactly. There's always an element of uncertainty. And it's important to remember both fundamental and technical analysis, they have their limitations.
Okay, good to keep in mind. So fundamental analysis is about the company itself. Technical analysis is about the market trends. Are there any other analysis techniques I should know about?
There's this growing field called quantitative analysis.
Quantitative analysis.
Or quant analysis.
Quant analysis, okay.
It's all about using math models and algorithms to try and find investment opportunities. Pretty complex stuff.
Quant analysis. Sounds intimidating.
It is. It's usually used by hedge funds and big institutional investors. They have the resources for that kind of thing.
Okay.
For us regular folks, sticking with the fundamentals and understanding market trends is a good place to start.
Okay, that makes me feel better. Now, no one's perfect, and we all make mistakes, especially with investing.
True. But remember, mistakes can be great teachers, as long as you learn from them.
Absolutely. I've made my fair share of investing blunders.
We all have. The important thing is to recognize them, figure out why they happened, and then adjust your approach.
Okay, so let's talk about some common mistakes. What are some pitfalls to avoid?
One big one is chasing performance. You see an investment that's done really well in the past, and you jump in without really thinking it through.
FOMO. We see that stock going up, 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 and we think we got to get in on that.
Yep, that's it. But past performance, it doesn't guarantee future results.
Just because something's hot right now doesn't mean it'll stay that way.
Exactly. Another big mistake, not diversifying. We talked about this before, but it's super important.
Don't put all your eggs in one basket. We got it.
Good. Because no matter how promising an investment seems, if you put all your money in one place, you're taking on a lot of risk.
So diversify, diversify, diversify. Got it. What else?
Well, we've talked a lot about emotions.
The emotional roller coaster.
Right. And how fear and greed can lead to bad decisions. Buying at the wrong time, selling at the wrong time.
Yeah, I've done that. 1 minute I'm super excited. The next minute I'm freaking out.
That's why it's so important to have a plan, stick to it, and not let your emotions run the show.
Okay, stay the course even when it gets bumpy. What about fees and taxes? How do we avoid letting those eat us alive?
Good question. Choose low-cost investments, like those index funds and ETFs. And take advantage of those tax-advantaged accounts, 401ks, IRAs. They can really help.
Okay, fees and taxes, the silent wealth killers.
Yeah.
Anything else I should watch out for?
This one's fundamental, not having a clear understanding of your goals.
Oh, yeah, our investing compass. We talked about that.
Exactly. If you don't know where you're going, any road will get you there.
So before I even buy a single stock or bond, I need to figure out what I'm trying to achieve.
Absolutely. What are your priorities? Retirement, buying a house, your kids' education. Those goals should be the driving force behind your decisions.
Makes perfect sense. But honestly, sometimes I feel a little overwhelmed by all of it.
I get it. Investing, it's complex. It's always changing. But just take it one step at a time.
One step at a time.
Keep learning. Don't be afraid to ask for help.
Okay, so I don't need to have all the answers right away.
Nope. Investing's a journey, not a destination. The more you learn, the more confident you'll become.
I like that. It's about embracing the process. Now, let's talk about something that I think gets overlooked sometimes, but it's super important, the psychology of investing.
Ah, yes, the mental game.
Right. Because I know my emotions, they definitely can get in the way.
It happens to everyone. Our brains are wired to react to threats and rewards, and the market, it can trigger those reactions big time.
So it's not just about numbers and charts.
Nope, there's a whole psychological side to it. And understanding how our minds work, it's just as important as understanding those financial concepts.
Okay, I'm intrigued. Tell me more about this psychology of investing.
Well, one of the key concepts is behavioral finance.
Behavioral finance.
Yeah, it's all about how our psychology, our biases, can affect our decisions.
Biases. Like what?
One common one is loss aversion.
Loss aversion.
Basically, it means we feel the pain of a loss more strongly than the pleasure of an equal gain.
So we're more scared of losing money than we are excited about making it.
Pretty much. And that can lead to all sorts of irrational behavior, like holding on to losing investments for too long or selling winning ones too soon.
Oh, I've totally done both of those.
And another common bias is confirmation bias.
Confirmation bias.
It means we tend to look for information that confirms what we already believe, even if that information's not totally accurate.
So if I think a stock is going to go up, I might only pay attention to the news that says it's going to go up and ignore anything that says it's going to go down.
Exactly. And that can lead to some bad decisions.
Okay, these biases sound dangerous. How do we fight them?
Awareness is a big one. Just knowing about these biases can help you spot them when they pop up.
So know thyself, right?
Exactly. And then try to get different perspectives. Talk to people who disagree with you. Read different sources. Challenge your own assumptions.
It's like getting a second opinion before you do something big.
Yeah, that's a good way to put it. Now, emotions, it's not just fear and greed. There are other ones that can trip us up too.
Oh, like what?
Overconfidence can be a big one.
Overconfidence.
People overestimate their abilities, their knowledge, and they take on too much risk.
So it's like, I could totally beat the market.
And it often backfires.
Okay, so overconfidence, watch out for that one. Anything else?
Regret.
Regret. Like regretting a past investment.
Yeah. You might make a bad decision, and that regret, it can stick with you. And then you end up making future decisions based on fear, not logic.
So like letting past mistakes control my present.
Exactly. Acknowledge the mistakes, learn from them, and move on.
Okay, investing is definitely a mental game.
It is. It's about managing your emotions just as much as managing your money.
I think I need to do some meditation before I make any more investment decisions.
Might not be a bad idea. But seriously, having a solid plan and sticking to it, that's key. Don't let your emotions call the shots.
Okay, I'm ready to conquer those emotional demons. But are there any, like, secrets to success? Or is it all just luck?
Well, there's no magic formula, but there are some principles that successful investors tend to follow.
Okay, I'm listening.
One big one is patience. I know we've said it before, but it's worth repeating. Building wealth, it takes time.
Marathon, not a sprint, I remember.
Exactly. And then there's discipline.
Discipline.
Sticking to your plan even when the market's going crazy or your emotions are all over the place. Don't chase those hot stock tips.
So stay focused, stay the course.
You got it. And continuous learning. That's huge. The markets are always changing, so successful investors, they're always learning, adapting their strategies.
It's a lifelong process.
It is. And finally, successful investors, they tend to have a long-term perspective. They're not trying to get rich quick. They're building wealth steadily over time.
Okay, I'm sensing a theme here. Patience, discipline, long-term thinking.
Exactly. It's all about building a solid foundation.
And then just letting it grow, letting it do its thing.
Right. And remember, investing, it's not just about accumulating wealth. It's about using that wealth to reach your goals, live the life you want.
So it's about more than just the money itself. It's about what the money enables you to do.
Exactly. Which brings up a good question. How do you measure success in investing?
Ooh, that is a good question. Is it just about how much money you make?
It's definitely a part of it, but ultimately success is about achieving your goals.
So everyone's definition of success is different.
Absolutely. One person might want to retire early and travel the world. Another person might want to buy their dream home or start a business. Maybe you want to make sure your kids can go to college.
So many possibilities.
Right. So figure out what success means to you and then let that guide you. Don't worry about what other people are doing.
Okay, that makes a lot of sense. Now, I think a lot of people struggle with this. Getting started with investing, it can feel really intimidating, especially if you're new to it all.
I totally understand. But remember, every expert was once a beginner. Just start small, keep learning as you go.
So I don't need to invest like a ton of money right away.
Nope. Even small amounts invested consistently can grow a lot over time.
The power of compounding, right?
You got it. So how do you get started? Well, first things first, figure out your goals. What are you saving for?
Okay, so goals first, then what?
Then do your research. Learn about the different investment options. Stocks, bonds, mutual funds, ETFs.
Okay, so figure out which players are on the field.
Yeah, and then think about diversification, remember? Spread that risk.
Multiple baskets. Got it. Then what?
Then it's time to open those accounts, 401k, IRA, brokerage account, and start putting your plan into action.
Okay, this is starting to feel real. What if I get stuck?
You're not alone. There are tons of resources out there. Financial advisors, websites, books, even podcasts. Don't be afraid to ask for help.
So I define my goals, I do my research, I build a diversified portfolio, I don't be afraid to ask questions. What's the last piece of the puzzle?
The most important part, start investing.
Okay, time to take action.
Yep, like anything else, the best way to learn is by doing.
I'm feeling inspired. Time to take control of my financial future.
That's what I like to hear. And remember, investing, it's not just about numbers. It's about empowering yourself to achieve your dreams.
That's a great way to put it. I feel like I've learned so much already.
Me too.
But I'm sure there's even more to discover in part 3 of our deep dive. Welcome back to the deep dive, everyone. We've been on quite a journey. We've talked about all those investing basics.
Building blocks, yeah.
Right. We explored all kinds of strategies, to help us level up our investing game. We even went deep into the psychology of it all those like mental traps we can fall into.
Right, those sneaky biases.
Exactly. But before we wrap up our exploration of the most important lessons in investing, I wanted to touch on one more area that's, it's kind of been on my mind lately.
Ooh, I'm curious. What's that?
Ethical investing. It seems like it's getting a lot of attention these days.
It is. It's definitely a hot topic.
So I'm wondering, is it really possible to, make a positive impact with our investments? Or is that just like a marketing thing?
Oh, it's definitely possible. Ethical investing, sometimes you hear it called sustainable investing or impact investing. It's basically about recognizing that our investments, they can influence the world around us, not just our own pockets.
Yeah. So it's like putting your money where your mouth is,
Yeah.
right? Like supporting companies that are actually doing good things.
Exactly. A lot of investors, I'm seeing this more and more, they want to support businesses that are making a difference, addressing climate change, social justice issues, that kind of thing.
That's awesome. I'd love to know that my investments are like contributing to a better future. But can you really do good and do well financially at the same time? Like, do those ethical investments actually make money?
That's the question everyone asks. And the good news is, yeah, they often do. There's actually research that shows that sustainable investments, they can perform as well as, or even better than, traditional investments.
Really? That's great to hear. So you don't have to choose between like profits and principles. You can have both.
Exactly. It's not an either situation. But, okay, so let's say I'm convinced I want to get into this ethical investing thing. Where do I even start?
Yeah, it seems a little overwhelming.
It can be. There are a few different approaches. Some investors, they like to focus on specific companies or funds that really align with their values.
So like if I'm really passionate about, clean energy, I could invest in a renewable energy ETF.
Exactly.
Yeah.
You can target those specific industries or themes that you care about.
Okay, that makes sense. What are some other approaches?
Another thing you can do is you can use your shareholder power to advocate for change, even within companies that you already own.
Oh, okay. So like I could vote on shareholder proposals or something?
Yeah. You can attend annual meetings. You can even engage with company management directly and push for more sustainable practices.
So it's about being an active investor, not just like sitting back and watching.
Exactly. You have a voice and you can use it to make a difference.
Right.
It's about holding those companies accountable.
I really like this whole idea of aligning investments with values. It just feels right.
It does, doesn't it? And the cool thing is, it's constantly evolving. New ideas are popping up all the time, so there are more and more opportunities to make a positive impact.
Yeah, it feels like a really exciting time to be an investor. Like we can actually use our money to make the world a better place.
I think so too. And this ties back to one of the main themes of the most important lessons in investing, the idea that wealth, real wealth, It's about more than just money.
It's about living a good life, a life you're proud of.
Exactly. Aligning your money with your values and using your resources to create a life that has meaning.
Well said. Okay, we've covered so much in this deep dive, I feel like my brain is full. Compounding, diversification, risk management, all those biases, ethical investing, it's a lot. But as we wrap up, what's like one key takeaway you want our listeners to remember?
One key takeaway. I'd say, remember that investing, it's a journey, not a destination. Keep learning, keep adapting, don't be afraid to make mistakes. And remember, the goal is to create a life that you love.
That's perfect. It's not about the numbers. It's about living a good life.
Exactly. And you don't have to do it alone. There are resources out there to help you. Financial advisors, books, websites, even podcasts.
Well, on that note, I think it's time to wrap up this deep dive.
It has been a journey.
It really has. Thanks for joining us and sharing all your wisdom.
My pleasure.
And to all our listeners out there, happy investing.
That's it for today's episode of Wealth Hustle 247. Be sure to follow, like, comment, and share with others. Keep pushing toward your goals, and we'll see you in the next episode.